I'm going to be honest with you. The biggest losses I ever took in trading didn't come from bad setups, bad timing, or even bad psychology. They came from believing lies. Lies that the trading world repeats so often that you stop questioning them and start organizing your entire process around them. I was building my entire trading career on assumptions that were completely false. I was unknowingly sabotaging myself. I mean, trading is already hard enough when you're aligned with how the market actually functions. When your system, your bias, your execution all make sense. Imagine how impossibly difficult it is when your decision making is built on lies that don't align with reality. That's what kept me stuck for years. I had a map that was pointing me in the wrong direction. So, in this video, I'll be exposing the 3 biggest trading lies that quietly destroys traders from the inside out and what you should be doing instead. Before we begin, quick disclaimer. Nothing here is financial advice. I'm just showing you what's worked for me. If you use it, do it at your own risk and size properly. The first one is that your edge fades over time. This is the worst one because it sounds smart, so most traders never really question it. You hear things like markets evolve, or algos adapt, or edges decay. Well, yeah, sure, if your edge is based on nothing. The thing with 95% of trading strategies is they're not actually strategies. If your so-called strategy is based on a few patterns or something superficial, then it won't last. If it's something like when we have a doji candlestick and then an engulfing candle, we go short, then obviously this won't work forever. Or if it's something like when the market breaks above a high and the RSI is above 70, we go long. Any strategy like this, no matter how complicated you make it or how many rules you stack on top, will eventually stop working. It doesn't matter if you backtest it 10,000 times. It's still just surface level pattern recognition pretending to be a system. And the reason is simple. Your strategy is superficial. You're staring at patterns and trying to force meaning into them. You're trying to memorize the market instead of understanding it. But you're not actually studying why price moved. You're not using market principles. You're not thinking about the actual mechanics and principles behind the market. You're just connecting dots and hoping the picture stays the same forever. And it never does. A trader that understands market fundamentals will understand what's going on. They understand what drives a move, what levels matter, how institutions position themselves, and how momentum flows. So even if the candles look different, even if the pattern is ugly, even if the chart looks unfamiliar, the underlying behavior is the same. That trader still knows the direction, while a superficial trader might get tricked or deceived by the same action. So a real edge doesn't fade. It'll take longer to learn, longer to trade profitably, but it's built on a strong foundation. It's built on principles that don't change, and not the patterns and setups that always do. So what are these fundamentals then? Well, it's simple: trend, momentum, and market structure. Regardless of how the market is looking or acting, these 3 forces are always there. They haven't changed in decades, and they aren't changing anytime soon. A trader who understands these fundamentals well can look at a chart, even if the candles look messy, even if the pattern looks unfamiliar, and still know exactly what side they need to be on or not be on. The trend gives you direction, momentum gives you conviction, and market structure gives you the context. This is the core behind every market move, and it's the lens you should be using to interpret the market as a trader. Don't fall for cheap strategies that are constantly changing. Build a strong fundamental base that allows you to trade everything at any time. And once you understand how the market moves, you also realize something else. Most of the fears traders have are based on complete fiction, which brings me to my second lie, and this one is particularly irritating. It's the lie that you're competing with hedge funds and institutions. People say this all the time, that hedge funds and institutions are full of algos and geniuses that code these algos, and they're able to squeeze every little edge out of the market. So the story goes, these guys dominate everything, and as retail traders, we have no chance of surviving against them. And you know what? This makes sense. Until you think about it. It's always someone who doesn't trade or doesn't know how to trade that says stuff like this. You're not competing with hedge funds because that's not how trading works at all. It's not like we're in a duel with them or a chess match. It's not a 1 versus 1 where if they win, you lose. We're all trading the same chart. Institutions aren't waking up in the morning and plotting to take your tiny account. They don't even know you exist. The only way you can lose your account like this is if you're constantly entering trades without much thought and placing your stops at horribly obvious places like a noob. But it's not that the algos are hunting you. This is just you underestimating the randomness and unpredictability of the market and arrogantly wanting the market to do exactly what you think it'll do. And as soon as it doesn't do that, you blame everyone and everything like they're conspiring against you. But this is just a case of surface level trading instead of trading with a real edge. Once you trade with a real edge, you realize that it's just a skill issue. There was no algo hunting you and no hedge funds trying to steal your account. You just sucked at trading because hedge funds and institutions literally are the market. They're the ones that move the market around with their massive volume. So saying that they're competing against you is like going surfing and saying you're competing against the waves. If you see a surfer constantly being wiped out, you're not thinking, damn, the ocean is out to get him. You're thinking, bro, you just don't know how to surf. Same with trading. But the good news is we can use these institutions to our advantage. Like I said before, institutions move the market because they move around massive volume. And we can follow these moves the same way a surfer surfs on a wave. What we do is map out institutional volume and find key areas where price reacted with force, because that's where the big players actually stepped in. These areas are what we call supply and demand levels. I go into exactly how to find these levels in detail in other videos, which I'll link here for you to watch right after this. But these zones matter because only institutions have the size to create those reactions. Retail traders don't cause big moves. We just ride them. So the goal isn't to beat them. The goal is to find where they previously showed their hand and align with the next wave of movement. Don't hold yourself back by believing you're in some battle you can't win. You're not fighting institutions, you're following them. And once you finally understand that, trading starts finally making sense. Which brings me to the third lie, and this is the one that might get everyone mad, but I'm going to say it anyway. The lie that price action is king. People treat price action as if it's some mystical language. Like if you stare at enough candles for long enough, the market will just magically make sense at some point in the future. The truth is, price action isn't king. It's not even in the top 3 on the list. And the reason is simple. Price action is almost entirely subjective, deceiving, and mostly random. If you try to build an edge from something unreliable like this, you're building on very weak foundations. Let me show you an example. This is the NASDAQ chart on the 2-hour. Take a few seconds to look at it and look at all the price action. Now, just based on what you see here, especially with the latest candles, would you say we're more likely to continue lower or move higher? We dropped sharply with lots of strong bear bars, then attempted to bounce up here, and got rejected at this little resistance. Then we had a sharp bearish engulfing candle here. Based on the price action you see here, what would you say? I'd say this is looking pretty bearish to me. Now I'll pull up another chart. So, what do we think about this one? If we look at the recent candlesticks, we see that we had sharp bear bars, then a very strong bounce, and a bullish engulfing. And now we seem to be consolidating and made a higher low right here. This seems a little more bullish than bearish, right? It's not necessarily something you'd want to go short against just yet. I'd probably lean bullish in this case. Now, what if I told you the 2 examples that I showed you are the same chart? And you might be a little confused because it looks a little different. But no, it's the exact same chart on the same time frame. The only difference is that I shifted the candles 1 hour to the right. So if let's say this candle would open at 1 p.m. and close at 3 p.m., and therefore complete the 2-hour candle, well then this same candle on the other chart would open at 2 p.m. and close at 4 p.m. You're still getting the exact same information, just that the candlesticks are printing them differently. That's interesting, isn't it? That means if we use price action to decide what our next decision is going to be, we're relying on something that changes depending on how you look at it. So, although price action might feel useful and reliable, it isn't. It changes depending on the time frame, the session, the data feed, the broker, the charting platform, and now you've seen it with your own eyes. Shift the candles by 1 hour and the story completely changes, and that's the whole problem. Price action has no predictive power on its own. It never did. The real compass, the thing that actually gives candles meaning, is everything we talked about earlier. Trend, momentum, and market structure. You can't expect to build a framework on something unstable and not expect it to collapse. That's why I trade using that framework, with a strategy called the LCE model, which makes price action mostly irrelevant and focuses only on core market principles. Once you build a foundation on something stable, then you can expect your results to be reliable as well. And by the way, that's exactly what we do in my LCE Accelerator program. We run weekly group calls where we break down trades and keep your process clean. You'll also have a private one-on-one chat with me, so you can get feedback or ask questions anytime. You'll get access to my exact level-to-level chart, the same one I use every day to trade this framework. And you'll be part of a private community of LCE traders who all trade the same system and hold each other accountable. So if you're interested, click the link below. And if this video helped, be sure to like, subscribe, and turn on notifications. I'll see you in the next one.